Back in the global financial crisis, a lot of people thought that the balance sheet expansion that they were going to do would be inflationary, or some even said hyperinflationary. And for the most part, it wasn't. And the reason was that money didn't really get out to the public. It wasn't helicopter money. It was recapitalizing the banking system, which is why I've described it as anti-deflationary rather than outright inflationary. And during 2020, when they were doing this latest round of the massive balance sheet increases, some of the people were saying, look, all the people said it'd be inflationary last time. It's not going to be inflationary this time either. Whereas one thing I was focusing on is this isn't like last time. This was literally helicopter money. This was massive fiscal spending that was then supported by all of this QE. And that's why we had that really big inflationary impulse. It was a huge increase in the broad money supply, all this. The type of QE that we're likely to see going forward is more like older QE, which is that it's not combined with necessarily any new fiscal stimulus. Now, those could be separate decisions by the administration. They could send out a check that they call, say, a tariff dividend, or they could do another tax cut. They could separately decide to do something fiscally, but they already have this kind of structural large fiscal deficit. And mostly what this change with the Fed does is it just keeps that train going. That part's already there. So I do think that part of the reason we have above target inflation right now, based on most ways that they measure it, is largely because of the fiscal side, and it just keeps that going.